With the markets doing very well, there is excitement as well as anxiety on what the budget has in store for capital gains tax. Several representations have been made to realign the capital gains tax regime and reduce the multiple tax rates, surcharges, and other rules like holding period across different asset classes. Hopefully, the budget will take the first step towards rationalization of the capital gains tax regime. One of the issues is on the high tax rate for derivative income. And as you know, derivative income is taxed at 30% plus surcharge for domestic investors and foreign investors. This rate is too high, especially considering the fact that derivative trading is also subject to securities transaction tax and other levies. The government could therefore consider reducing the tax rate for derivative contracts to a more moderate rate of, say, 15 or 20%. Also, the rules around loss offset on derivatives should be relaxed. This is particularly important as SEBI has been rightly concerned about small investors losing money on derivative trades. Distribution tax on buybacks or dividend distribution tax akin to a buyback distribution tax is a tax liability for corporates without taking into account the total income, tax status, and the residential status of a shareholder. Effective April 20, dividend distribution tax has been abolished and dividends are now taxed in the hands of investor. However, the distribution tax on buyback still continues. The distribution tax regime also does not provide for a corresponding credit of taxes in the hands of shareholders, and therefore it results in some kind of a double tax of the same income in the hands of different taxpayers. In line with abolishment of dividend distribution tax, the government could also consider abolishing the distribution tax on buybacks, and income should only be taxed in the hands of investors as capital gains tax. The AIF industry has been hoping for tax transparency for category 3 AIFs, especially long only funds, such that income will be taxed only in the hands of investors. This will enable AIFs, such long only AIFs, to attract more serious institutional money, both domestically and from global investors. Thank you.